Welcome to the deep dive. Today, we're really jumping into something pretty wild. One of the most, chaotic, exciting, and frankly devastating phenomena in recent capital markets. We're talking about the rise, the fall, and the complete regulatory reset of the Special Purpose Acquisition Company, the SPAC, or as many called it, the blank check company.
Right, the blank check company. It really captured a moment, didn't it?
It really did. So our mission here is to walk you through that whole story. We want to unpack what made the original model, let's call it SPAC 1.0, tick. Those structural incentives that just fueled that massive boom in 2020, 2021. Then figure out why it crashed so hard, spectacularly, and destroyed so much shareholder value.
Yeah, the aftermath was brutal.
And finally, analyze the big changes the SEC brought in 2024. These new rules basically created what we can think of as SPAC 2.0.
It's a crucial story because, honestly, understanding the SPAC cycle helps you understand peak market euphoria, peak speculation. At its heart, a SPAC is, it's a shell company, publicly traded.
Right. No operations.
No operations at all. It's formed just for one reason: raise cash in an IPO, and then it has a deadline, usually 18 to 24 months, to find and buy an existing private company.
That's the de-SPAC transaction, the merger part?
Exactly, the de-SPAC. And if they don't find a target within that time, they have to liquidate and give the IPO money back to the shareholders.
Okay, let's get into the engine of SPAC 1.0, because the structure wasn't just, complicated. Some would say it was almost rigged from the start.
It certainly had some deeply misaligned incentives baked in.
So during the IPO, the shares were always priced at $10. Always $10.
Yep, the standard $10 unit price.
And that money, the cash raised and went into a trust account. It was ring-fenced, totally safe.
Correct. Held in typically very safe assets, like short-term government bonds.
Now, this created what people called a heads I win, tails I don't lose situation, especially for the initial big investors, hedge funds and the like.
Absolutely. It was a pretty sweet arbitrage opportunity for them.
Explain that. How did that work?
Well, they'd put in their $10 per share. Then later, when the SPACs announced the company it wanted to merge with, if the hedge fund didn't like the deal, maybe the valuation seemed too high or the company looked weak, they could just redeem their shares.
Redeem and get their full $10 back from the trust account. Cash back, guaranteed.
Exactly. Full principal back. But here's the kicker.
There's always a kicker.
When they invested initially, they didn't just get shares. They often got units, which included shares and detachable warrants.
Warrants. So, like options.
Pretty much. Free options to buy more stock later, usually at $11.50 per share. And even if they redeem their $10 shares, they often got to keep those warrants.
Wait, so they get their money back and keep a free lottery ticket on the stock's potential upside.
Bingo. Risk-free speculation, essentially. Yeah. They use the public investor's trust account as their safety net while keeping this speculative upside.
Okay, that alone seems like a major structural flaw. But maybe the biggest issue, the one that really drove bad behavior, was the sponsor promote.
Oh, the promote, yeah. That's the heart of the misalignment in SPAC 1.0.
Tell us about that. How did that work?
So the management team, the people who actually set up the SPAC, the sponsors that got what were called founder shares. These shares typically represented 20% of the total shares outstanding after the IPO.
20%? For what kind of investment?
That's the crazy part. For a nominal amount. Sometimes just $25,000.
$25,000 buys you 20% of potentially hundreds of millions or even billions in equity value post-merger.
Precisely. Think about that incentive structure. You have almost zero capital at risk, but you stand to gain an enormous windfall if any deal closes.
Any deal at all.
Any deal. Because if the SPAC failed to find a target within that 2-year window and liquidated,
they lost the promote.
You lost the whole thing.
Yeah.
Your 20% stake became worthless.
Yeah.
So the pressure to just get a deal done, any deal, before the clock ran out, was immense.
Regardless of deal quality.
Right.
Or long-term value for the shareholders who actually bought in at $10.
Exactly. It incentivized speed and completion over careful vetting and fair valuation. The sponsor's payday depended on closing, period.
Okay, so that's the sponsor side. Now flip it. If you're a private company, why was the SPAC route suddenly so appealing compared to a traditional IPO?
2 huge reasons, really. Speed and, let's say, marketing flexibility.
Okay, speed first.
A de-SPAC merger could often be done in, say, 3 to 6 months. Much faster than a traditional IPO.
Which can take how long? A year? 18 months?
Easily. 12 to 18 months wasn't uncommon, with all the roadshows, regulatory filings, market uncertainty. A SPAC offered a faster, more certain path to going public.
Got it. And the second reason? the marketing flexibility.
This was probably the single biggest advantage and a massive legal loophole.
Okay.
SPACs, because they were structured as mergers, historically fell under legal rules that were more permissive about using forward-looking financial projections.
You mean forecasts, like we project we'll have $1 billion in revenue in 5 years.
Exactly that kind of thing. They could market the deal based on these often very aggressive, very optimistic future projections, protected by a legal safe harbor.
Whereas a traditional IPO is much stricter, right? More focused on historical performance.
Very much so. IPOs are generally restricted to audited historical financials. Showing rosy 5-year forecasts is heavily frowned upon due to liability concerns.
So this SPAC loophole was perfect for what kind of companies?
Pre-revenue electric vehicle startups, speculative biotech companies, early-stage tech firms with big dreams but no profits yet.
The kinds of companies that sell a story, a narrative about the future.
Precisely. They could use the SPAC structure to sell that future growth story to investors, often with projections that, in hindsight, looked, well, wildly optimistic.
Okay, so you have these flawed incentives, this regulatory loophole, and then the market environment just poured gasoline on the fire.
Oh, absolutely. The 2020-2021 boom was fueled by a macroeconomic perfect storm.
What were the key elements?
Number 1, ZIRP, zero interest rate policy. Central banks had interest rates pinned near zero.
And tons of liquidity being pumped into the system too, right? Quantitative easing.
Massive liquidity injections. Money was essentially free, and safe investments like government bonds offered almost nothing in return.
So investors were chasing yield.
Desperately. They were pushed way out on the risk spectrum, looking for any kind of return, even if it meant funding highly speculative ventures. Narratives trumped fundamentals.
And the scale of this frenzy. It was just off the charts. You mentioned the peak funding.
In 2021 alone, SPACs raised a staggering $162.5 billion. Just think about that number.
And they were dominating the ITO market.
At the peak, yeah. Something like 72% of all U.S. IPO proceeds were raised via SPACs. It wasn't just a niche product anymore. It was the IPO market for a while there.
That's peak euphoria territory. If you're tracking overall market temperature, that's a flashing red light.
Exactly. It's a classic sign of a market totally detached from fundamentals. And then you had the hype factor.
The celebrity sponsors.
Yeah, you had people like Shaquille O'Neal, politicians, famous hedge fund managers like Bill Ackman, lending their names to SPACs.
Which drew in retail investors.
Absolutely. A lot of less sophisticated investors piled in, often based just on the sponsor's name or the exciting narrative of the target company. Look at Lucid Motors. That SPAC stock went up something like 500% before the merger even closed. Pure hype about finding the next Tesla.
But hype built on shaky foundations eventually collapses, and the crash, when it came, wasn't pretty.
No, it was brutal. Post-merger SPACs, as an entire asset class, were a systemic failure. The data is just damning.
What did the study show?
Well, if you look at the SPACs that merged in 2019 and 2020, their average return 12 months after the merger was negative 34.9%.
Wow. Losing over a third of the value within a year.
And it got worse. The later cohorts, the ones merging in the peak frenzy of 2021 and 2022, they lost an average of 59% to 67% of that initial $10 value.
Almost two-thirds wiped out.
By December 2022, the average share price for that whole boom cohort had crashed to just $3.85 from a $10 starting point.
Devastating. And how did the structural flaws contribute to this crash? You mentioned redemptions earlier.
The redemption crisis was where the rubber met the road. As market sentiment soured, those sophisticated investors, the hedge funds.
The ones with the heads I win, tails I don't lose deal.
Exactly. They saw the writing on the wall and exercised their $10 redemption rights en masse.
So they pulled their cash out before the stocks collapsed further.
That's right. Redemption rates, which had been manageable, suddenly soared. We saw averages of 43%, 67%, sometimes even higher.
What did that do to the deals?
It starved the target companies of the capital they were promised. Imagine you're a private company. You think you're getting $300 million from the SPAC trust to fund your growth.
But then 90% of the shareholders redeem.
Right. Suddenly you're left with maybe $30 million.
Yeah.
That happened in some cases. BuzzFeed's de-SPAC saw nearly 95% redemptions. They expected hundreds of millions, walked away with about $16 million.
That's catastrophic for a newly public company.
It completely undermines the purpose of going public.
Yeah.
And for the retail investors who didn't redeem, who held on.
They were left holding the bag.
Pretty much.
Yeah.
Because now the true cost, the crushing dilution inherent in the structure, became painfully obvious.
Let's focus on that dilution math. Because this is critical. You had the 20% sponsor promote,
Yep, free shares for the sponsor.
the warrants that went to the early investors,
More free potential shares diluting the pot.
plus underwriting fees, advisory fees.
All paid out of the SPAC proceeds. So studies found that for the median SPAC, that $10 share investors paid, it was only backed by about $6.67 in actual net cash by the time the merger closed.
Only $6.67. So right off the bat, nearly a third of the value wasn't cash supporting the company.
Correct. The other $3.33 roughly was instantly gone, allocated to the promote, the warrants, the fees.
So public investors were starting in a hole. They needed the stock to rise more than 30% just to break even on the cash value.
Essentially, yes. That inherent massive dilution was baked in. It predictably led to the terrible post-merger returns. The system was stacked against the public investor from the start.
Okay, that level of failure, that kind of data, it couldn't be ignored. The calls for regulation must have been deafening.
They were. Retail investors got hammered, the structural flaws were laid bare, the SEC had to step in.
Which brings us to January 2024. The SEC drops a comprehensive set of new rules. The goal was basically to reset the whole thing, right? To create SPAC 2.0.
Exactly. The core idea was to align the de-SPAC process much more closely with the standards and liabilities of a traditional IPO. No more regulatory arbitrage.
And what were the biggest changes, the real game changers?
Two stand out as the most profound. They directly attack the biggest advantages SPAC 1.0 had.
Okay, what's the first one?
Liability. A huge shift in liability. Under the new rules, the private company being acquired and its directors must now be co-registrants on the main SEC filing for the merger.
Co-registrants, what does that mean in practice?
It means they are now subject to strict liability under Section 11 of the Securities Act, just like in a traditional IPO.
So, if there are material misstatements or omissions in the disclosure document,
They can be sued. Personally, the target company leadership is now directly on the hook for the accuracy of the information given to public market investors.
that's a massive change from before, where they were somewhat shielded by the merger structure.
Huge. It dramatically raises the stakes for the target company. You're far less likely to sign off on wildly optimistic projections if you face personal liability for them.
Which leads perfectly into the second major change. They tackle those projections directly.
They killed the safe harbor, explicitly.
The legal protection for forward-looking statements in SPAC deals, gone.
Gone. The rules state clearly that the safe harbor under the Private Securities Litigation Reform Act does not apply to de-SPAC transactions.
So companies now face much higher liability risk if they use those aggressive, unsubstantiated forecasts.
Absolutely. It forces them to be far more cautious and realistic in their projections, much like they'd have to be in a traditional IPO. It removes that key incentive for speculative companies to use the SPAC route.
Okay, so increased liability, no more safe harbor for projections. What about transparency, especially around that dilution issue?
Big focus there, too. The SEC mandated much clearer, standardized disclosures about all sources of potential shareholder dilution.
Like the promote, the warrant.
Everything. The rules require prominent disclosure, often in tables right on the cover page of the prospectus, detailing the impact of the sponsor promote, the warrants, the underwriting fees, PPE financing, you name it.
So investors can clearly see how much their $10 share is being diluted from day one.
That's the goal. Make it $10 isn't really $10 of math impossible to miss.
And what about the sponsor's conflicts of interest?
Also needs much more granular disclosure now. Sponsors have to clearly lay out their compensation, any lockup agreements on their shares, and explicitly describe the conflict that arises because their promote depends on getting any deal done.
So basically, the SEC is forcing everyone to put all the cards on the table, especially the ones that show how the deck might be stacked against the public investor.
That's a good way to put it. Shine a bright light on the costs and the conflicts.
So connecting this back to the bigger market picture, the whole SPAC saga really does feel like a market barometer, doesn't it?
Definitely. The 1.0 boom was a textbook signal of peak euphoria, a time when narrative completely overwhelmed fundamental analysis. If you track market sentiment, that was the top.
And the crash, starting in late 2021, early 2022.
That was the canary in the coal mine. Because SPACs were the most speculative, most structurally fragile part of the market, they cracked first when the tide turned.
Signaling the end of easy money, the shift to a risk-off environment as interest rates started to climb.
Precisely. It led the way down for the broader market correction.
So for the retail investor looking at SPACs today in this SPAC 2.0 world, what's the takeaway? Are they safer now?
Undoubtedly safer in terms of information. The playing field is much more level. The SEC's goal was to ensure you, the investor, are armed with the same quality and quantity of material information as you'd get in a traditional IPO.
The information asymmetry has been significantly reduced.
Yes, but, and this is absolutely critical, the rules mandate disclosure of the problems. They don't eliminate the problems.
Meaning?
Meaning the costs are still there.
Yeah.
The sponsor promote, that 20% free equity stake, still exists. The warrants might still exist. The inherent dilution is still a structural feature.
It's just labeled more clearly now.
Exactly. You're still paying for the sponsor's promote through dilution. The conflict of interest for the sponsor to get a deal done rather than the best deal still exists.
So due diligence is still paramount.
More critical than ever, maybe.
Yeah.
But now you have better tools. You must look past that $10 nominal price.
Use those new disclosure tables.
Yes. Scrutinize the sponsor's track record. Do they have expertise in the target industry? Do they add value beyond just finding a deal? And critically, use those dilution tables to calculate the real net cash per share you're getting.
If it's still only, say, $7 in cash behind your $10 share.
Then you have to ask, is this target company so exceptionally good, so undervalued, that it can immediately overcome that 30% deficit and provide strong returns going forward? That's a high bar.
Okay, summing this all up, it's been a massive transformation. The SPAC clearly isn't the revolutionary regulation-light vehicle it was positioned as.
Not anymore. It's been forced into a much more constrained, highly regulated role.
And the market volume reflects that, right? The speculative money fled.
Completely. Going from over 600 SPAC IPOs in 2021 down to just 31 in 2023 tells you everything. The frenzy is over.
So what's the future then?
Well, the new rules act as a powerful quality filter. SPAC 2.0 likely only works if those remaining advantages, mainly speed and maybe some valuation certainty compared to a choppy IPO market, are compelling enough for a high-quality private company to justify paying the inherent costs of the SPAC structure.
And crucially, they need to deliver actual positive returns for the public shareholders post-merger.
That's the bottom line. The market now demands results, not just slick projections.
Which leaves us with the final question, really. Will these new rules ultimately turn the SPAC into a stable, perhaps niche tool for genuinely good companies that can make the math work for everyone? Or has the whole structure, the complexity, the costs just been too discredited in the eyes of investors, regardless of the new oversight?
That's the billion-dollar question, isn't it? Only time and actual post-merger performance under these new rules will tell that story.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you found this topic interesting and want to hear more in-depth analysis, remember to subscribe to us on Apple or Spotify podcasts at Deep Value Investing.